Welcome back in, everybody. I'm sorry it's been a moment since I've posted. A lot of different things going on in my life right now, and we recently had a death in the family, which has been pretty tragic, and so we've been working through that. And in today's video, I'm going to talk about what's going on in the market internals, what I'm personally seeing, how we're performing against the market, because guys, on this channel, we do talk about individual stocks, but I always just recommend dollar cost averaging into a broadly diversified index and set it and forget it. But specifically, we focused on distressed, depressed assets on this channel that still have some fundamentals underneath them where we can get an outperformance compared to the market, or at least try to get some outperformance compared to the market. Don't recommend doing this. This is just my journey and for entertainment purposes only. In this video, I want to talk about a few strategies I'm using, and now I'm starting to look at building cash, and we're going to go over why that is. Now, if you're new to the channel, welcome into Compounding Capital, where we take a fundamental approach to investing along with long-term price action. So in the account, we can see over the last few months, we've had a really nice pop in our account. When we really started this account back in May, we were massively underperforming because we were buying those assets that really had bad charts. The selling pressure was there. And so naturally we're trying to catch a falling knife, which is always dangerous, especially when the fundamentals are in question. But now we're starting to see that we are catching up to markets. We're up 6.4%, which, the Russell's been on an absolute tear. So now the Russell's beating us, but we're actually beating the S&P 500, we're beating the Dow Jones, and we're beating the NASDAQ, surprisingly enough. With the recent tech sell-off, and we're starting to see more of those value names get a bid underneath them, we kind of timed this pretty well here, and we're reaping the benefits of that. Now, in this portfolio, a lot of my returns are actually going to come in the form of dividends. And as you guys can see here, I am sitting on some cash. Reason being is I did sell out of Warner Brothers Discovery. It made a pretty substantial move up, and I think that the move is overdone, and I'm looking to re-enter. So I believe market volatility is definitely going to pick up here. We're going to see some crazy price action. We've seen a heck of a move in Pfizer, guys. We've been getting in this stock right around $26 a share, $25, $26 a share. We were getting over a 6% dividend. They're going to try to keep this dividend intact, and that's not why we bought it. We figured that earnings were troughing here with the recent pipeline, that we were going to start seeing earnings turn around, which does mean price action will turn around. So now I want to talk about what I'm doing with Warner Brothers Discovery here. Warner Brothers Discovery started buying around $7 a share. It shot up to $8.35, and we sold out at that point in time because the move to me was a little overdone, and there's still a lot of questions. This is a long turnaround story. I still believe that, this thing's going to bounce anywhere between $6.50 all the way up to $9 a share. I think it's going to be very volatile. There's going to be a lot of question marks. They're still dealing with a lot of debt. And so look to get back in at a lower price. And if we don't, what we're going to do is we're going to get income from premium on options. So we wrote an option call here just a little bit over a month out for $7.50. We bought those options for 25 cents a piece. They're now worth 16 cents a piece, which means that we're up $42 on those options. And so kind of just to go over what my thought processes were, I definitely want to own the stock. I took profits already in the stock. And so at this point in time, I'm just looking to collect premium and or get back in the stock. And so here's how my thought process went. At $7.50, I got 500 shares on hold, which is $3,750 that's sitting on the sidelines, locked up, waiting for that price to get hit and waiting for that date to get hit. In the meantime, I collected 25 cents on 500 shares, which came to $125. In just over a little bit of a month, I collected $125 on that $3,750 investment. We divide that $307.50, and we get a 3.3% rate of return. So basically, in just over a little bit of a month, I'm getting a 3.3% rate of return on Warner Brothers Discovery if the stock stays above $7.50. Now, if it's $7.50 or below, then I get filled at $7.50. And so this is where options can go against you. I'm collecting 3% in premium. I already made right around, call it 16-17% on the stock. So we factor in that 3% premium. I basically have made 20% on the stock if the stock stays above $7.50 for the duration of that contract. Now, if the stock goes below $7.50, I either can sell those premiums for a loss, sit back and just let it get filled at that price, So that's where options can go against you. You start having to make those decisions a little bit harder. And normally I don't like to go a month out, but for 3% of premium, I felt like it was a pretty good deal and I'm already up in the stock. So I built some safety in my position as well. So there's multiple reasons why I thought this made a lot of sense. I thought the stock moved too fast, too short. I think there's a lot of volatility with the stock. And I also figured that I do still want to own the stock, but I would like to own it at a lower price now. And so I built some safety there overall. And if the stock goes up and the decay happens, I will probably be able to sell it for 12 or 13 cents, meaning that I can get 1.5% in less than a week. And I might actually take it up on that and sit in cash. And so it's really important for us to outperform the market, because otherwise, why are we spending all this time? Why are we taking on the risk if we can't even outperform the market? So it's very important that you look at total returns of your portfolio versus the indexes, because if you're an individual stock buyer and you're not beating the markets, then I think you should just put it in an index, have it professionally managed, set it, forget it, and not have any stress. We're putting some substantial time in this channel. We're putting substantial time in these stocks that I'm personally picking. And so I need to be beating the market. Otherwise, I'm just not getting compensated for that time. And I could technically work another job and just put more money into an index and still do very, very well for myself. And so I want to talk about what's going on in the 10-year treasury. The 10-year treasury is actually coming down, and that's forcing a lot of action to come out of treasuries and into dividend paying stocks. And this has been my thesis going forward, that the deep value dividend paying stocks, companies that have good balance sheets that are kind of getting overlooked by the market, are going to be companies that you actually want to own and will be outperformers, as we're watching tech essentially start hitting a wall here. And so just to go over a few different names that we've talked about on the channel that I thought had a tremendous amount of upside, low risk, paid dividends, and basically had earnings insulated, meaning that the earnings were not going to deteriorate if we saw the economy deteriorate. And that was companies like Raytheon Technology, Pfizer, Verizon, AT&T. These are companies that I brought up and did videos on that I thought were deep value companies when the sell-off initially took place. You had companies like Verizon trading close to $30 a share, now pushing $40 a share, and you were able to reinvest nearly an 8% dividend into that, which is a substantial return. Raytheon Technologies is nearly up 100% from when I did my video. So when we look at the PE ratio of the S&P 500 trading at 27.4 times earnings, this is a very interesting setup here, because the S&P 500 to me has definitely become the triple Qs. When we look at how they're weighted, technology to me really overweights this index that kind of covers up the true problems that are taking place here. And for right now, I think it's rightfully so, because when we look at earnings growth, they're expected to come in around 12.1%. And we're looking at a higher percentage of company beating earnings. So we see Morgan Stanley has right around $269 a share in 2025 of expected earnings for the S&P 500. So if we take those 269 earnings and we multiply it by a 20 multiple, we're basically getting a 53.80 S&P. And so this is kind of where I have a hard time investing in the index at nearly 21 times forward earnings, with a lot of question marks going into 2025 on labor markets and the delayed effect of monetary policy. And so that's where I think individual stock picking does make sense for somebody like me who puts the time in, has a process and puts the efforts in, but it's high risk, right? We've talked about this numerous times. So we've had this beautiful trend line from the October lows here. And what I want to point out is we broke through this trend line, and yes, we could definitely reach back up, and I do think that'll eventually happen. But the market literally bounced to the penny on a short-term trend line here. And so how I think this is going to play out is we will complete a 9 count to the downside. We're sitting at a 7, so 2 more days of trading I think is going to be choppy, but we can definitely gap up and still be within that 9 count completion. And so this trend line is the first time that this trend line has been broken in a substantial amount of time, and broken this hard. And so I do think we will possibly see it pop back up, and I do think we're probably putting in a double top here. And so when I'm kind of leaning on the technicals and the fundamentals here, I'm saying that historically trading at nearly 21 times earnings is pretty expensive. I don't think I'm getting a deal. And when I want to buy stocks, I want to feel like I'm getting some sort of a deal here. And so I do think there will be a sell-off both from a technical standpoint and a fundamental standpoint in order to get valuations kind of back in line. My thesis right now is most likely a clear double top, but I also think there's a case for a head and shoulders pattern here. So we have a left shoulder right here. We have a head here, and we also could just start formulating and trade sideways on this trend line and it being resistance and formulating that right shoulder, which could then bring us back down to the 200-day moving average or possibly back down to this recent breakout that we had. So those are a couple cases that I could see coming and how I could see the market playing out with the fundamentals lining up with some of the technicals. I don't normally rely too heavy on technicals. When I start getting more on the technicals is when companies I like are in a massive downtrend. I try to find some sort of bottom or technical bottom that takes place that line up with the fundamentals, and vice versa. When a company is getting really, really expensive, is there some sort of technical warning that it's trading for a substantial premium? Are we starting to see something? And so that's how I think this is going to play out here. I think there's a lot of money still on the sidelines that's going to move, and we're going to see this great rotation into more deeper value type names that we've been seeing kind of play out here. We've seen it with 3M. We've seen it with AT&T. We've seen it with a lot of different companies here that we're trading for very depressed valuations that pay dividends and kind of suit what those individuals that are sitting in treasuries are personally looking for here. So that's kind of my thesis on the overall market, kind of give you guys my 2 cents where my mindset is. At this point in time, I'm probably going to hold the positions that I have. I wouldn't mind getting back into Warner Brothers Discovery. As I stated, I do think it made a pretty significant move pretty quick. I think it's a high risk play once again. I think the valuation's pretty depressed though overall. But going forward, my goal here now is really looking at quality technology names that could lend an opportunity to be a buying opportunity. So as always, guys, really appreciate your time. Thank you so much for spending it with me. Click that thumbs up if you like this kind of material and consider subscribing to the channel. We will see you in the next one.